Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with a breakdown of the action in today's session and a look at how the week panned out. And not very good is how it panned out, Ed, with a brutal finish to the week. Can you hear me, Ed? You are on mute, my friend.
It's there. Okay.
Yes, we got you now. But yeah, it was a brutal
There we
end to the
go.
week. Brutal end of the week.
Yeah, brutal end of this week, and I'm continuing it on through after the close. It was wiped out almost all the gains. Do want to take a look at Vertex, which held up on semiconductor, which is now more an off semi, and Exxon Mobil, which was one of the leaders this week.
Yeah, we'll get to those. But first, let's take a look at the major indexes. On Friday, the NASDAQ down 3.8%, definitely the hardest hit of the major indexes, but followed by the Russell 2000 with a decline of more than 3% today. Also followed by the S&P 500 with a decline of 2.8%, and the Dow dropped 2.1%. So ugly losses across the board. We had a couple of warnings from some big players out there. Also, the jobs report was not what we wanted to see. It's all about the Fed right now, and those numbers definitely indicate or don't indicate that there's going to be a let up just yet by the Fed.
Yeah, I mean, there was so many hopes once again for a Fed pivot, and there really wasn't too much evidence for it. And it was, but really, I mean, this week was sort of textbook. The market was oversold coming into the week. We were rebounded from bear market lows. I mean, the NASDAQ technically wasn't there, but it was essentially there.
Right around that longer term level.
We got about 10 points within the bear market low. So if we undercut this, we're probably going to get there. Meanwhile, so we bounced up for a couple of days. Then we immediately hit resistance right where you might expect it to, right at the 21-day line. And then we tumble back as the treasury yields in dollar come back. So all of this is sort of like, yeah, you could expect this. You could expect a bounce. You could expect resistance. And the treasury yield, which came down quite a bit, and the dollar, which came down quite a bit, they both closed with gains. The 10-year treasury yield, 10 weekly gains. You know, you can talk about, oh, there was a drop to begin, but ultimately, it was a decent week for the 10-year yield. Terrible for everybody else. Right. But that's reflective. And the Fed pivot hopes, for all the talk of Fed pivot, I mean, the strong jobs report and other things, the odds of a 75 basis point hike in November already strong, even stronger at the end of this week versus last week. There's now starting to be a decent chance of a 75 basis point hike in December. Still probably going to be 50 basis points, but instead of a Fed pivot, it's continuing hard on the gas that way. Right. So the rally attempt continues as long as we're above those major indexes, or with the lows. But man, are we reeling? You can just look on a weekly basis. Yes, we're up. So if you didn't know what had happened and you said, oh, the market is up, I don't know, it probably was a little better. Let's say it's 1% for the NASDAQ. Oh, that's not so bad, but it was up a lot to start the week, and it just got hammered from there. Not what you want to see. There's a good chance that we could be now heading lower towards 10,000, towards maybe the pre-COVID highs. Those are just some logical areas. Doesn't have to go there, doesn't have to do any of that. I think investors should be very cautious. We can talk about more of that, but this was promising start and a really disappointing end.
Yeah. And even though we did see an oversold bounce, you know, maybe some investors wanted to add exposure, but I mean, we've been pretty cautious about, trying to make big bets ahead of Fed related, news items like the jobs report, just because, in recent history, there have not been very favorable reactions, whether it was Jackson Hole, other, rate hike decisions. There's a lot of volatility and negativity that can happen. So making a big bet ahead of this jobs report was not something that we were very enthusiastic about doing.
You made a good point, because Jackson Hole, we sort of rallied, rallied a little bit into it. Then the CPI, we rallied pretty nicely into it. And so we keep on rallying into big reports, hoping that we'll get good news out of it, rather than, hey, let's wait, let's see. Now, that's the market, not what I say we, but the market. So we have the CPI report next week. Maybe at some point the market won't rally into it. But that shows you still a lot of optimism, maybe too much optimism, despite what some market gauges are there. Investors still want to believe in a bull market that may not be there.
And Jojo's quite concerned about the stock market and economy as well. So there's that for you. But now let's go on over to, let's see here. Let's take a look at some sector action, shall we? So here's a look at XLE, the ETF tracking the energy sector. This area had a really nice week this weekend, up almost 14%. So really bucking the weakness. And it seems like this has been the one area that can, not always does, but can make some strong moves even when the broad market is really struggling.
Yeah, I mean, oil prices, went up, I think 16.5%, a massive move. And you can see that with USO, which basically tracks that huge move back above $90. So nice action there. Actually, the higher energy prices and when energy stocks go well, that may not be a good sign for the rest of the market, because at this point, this is going to start pushing up gas prices. Gas prices are already rising a lot, especially here in California, because of some refinery issues. But this fundamental issue is that even as those refineries come back online, these crude prices are pushing up. That just makes the Fed's job worse. Also notice that today, despite oil being up like $4 or 4% just today alone, XLE was down a little bit. At some point, when the Wall Street is down that much, some of those stocks can come down. That may not be the worst thing, because some of these have run up a lot. So it wouldn't be the worst thing if some of these energy names paused,
Right.
and let the 50-day line catch up. But they have had a huge run. This has been the leader. This is where it all is at.
But you're right. That doesn't mean that it's guaranteed to continue to work, guaranteed to go up even if we see that underlying commodity go up. So something to keep track of. But to kick off the week on IBD Live, we were talking about a number of stocks in this theme that might be worth considering. And let's also take a look at the chip sector. So here is SMH. Quite a hard hit today on that AMD warning. So SMH down 6% Friday. So giving back a lot of what was going to be a pretty strong weekly gain. But this mirrors what we're seeing with the NASDAQ.
Yeah, exactly. This was that. And there was also some expanded ban on chip technology to China. So a lot of these names really came off hard. You're looking for that bounce, and this is one problem when you're trying to buy fallen leaders, beaten down stocks, is that they can run up, but boy, they can come right back down.
That they can. All right, well, let's take a look at some stocks for our watch list. Like Vertex has a lot going for it, with a relative strength line, blue dot, top marks in many of the proprietary IBD ratings for the week, managed a gain of about 2%. Also, blue dot on the weekly chart as well, arguably presenting an entry, clearing a trend line here, Ed. But this stock, with it being just 3.5% below its 52-week highs, I mean, there's not a lot of stocks in the market that can say that right now.
No, there aren't. So you probably could buy it now. You could, if you waited till a breakout, it wouldn't be crazy extended from the 50-day line, because this is a very shallow base. I mean, most of the breakouts when we talk about, the handles might be 20% deep, the bases might be 35% deep, but this is not much. So if it got above that, it wouldn't be the worst, but you could buy it now. You do have to wonder, how much headway can a stock like this make? Like it's gone sideways for the past couple of months, but you're putting in a risk.
Right.
What if, I mean, there's always the risk that Vertex says, oh yeah, our sales tumbled, or this trial fails. I mean, this is a giant biotech, so it's not going to collapse 80% or something, but you never know. And so what's the upside against the possible downside? So that's just an issue, but this is clearly one of the strongest stocks, and definitely worth watching for sure.
Yeah, so it seems like, Ed, for those who do want to be disciplined and wait for signals that the overall market is getting better before adding too much exposure, it seems like this is one that you could, if it is still close to those moving averages, when we do see that market turn, you don't need to buy it now, like you said, because it's really just gone sideways. So maybe just keep your powder dry for better conditions. And again, if this is a stock that continues to hold up, because sometimes, as you've always pointed out for us, stocks can hold up until they don't.
That's right.
But we'll be keeping tabs on Vertex here. We also want to take a look at on semiconductor was on the watch list, maybe not quite at the top of the watch list now with a big hit today, down over 7%, some strong volume behind the move. It's still holding above its lows from late September, early October, but a pretty big hit today, Ed.
Yeah, I mean this was above a trend line entry on the last couple of days. So you could have bought it, but I mean obviously but this is the danger. This is why the danger of buying in an uncertain market right ahead of big news. I mean obviously you would have, if you bought this on Wednesday and then we had a jobs report that the market liked, it's up 7% say, or an AMD doesn't warn, all of a sudden, it seems such a great move, but this just shows you the danger. So that's why you have to be careful in this kind of environment because this was looking good. It was RS line was at a new high. This was in a buy zone. A lot of things were going well. And now, it's still flashing down on a weekly.
Yeah.
But
But at the very least, needs more time.
it needs more time. And of course, when it does come, it may still be volatile. So it's just something to watch out for. Something you can still watch it, but just a lot of dangers in this market.
Yeah, because I feel like that says something, right? This was a stock that we were very hopeful about in terms of its potential. And so to see a leader like this get dinged that hard, again, you had sector specific news here. But if the strongest stocks in the market can't hold up and resist that pull down in the market, I mean, like you said, that shows that it's a treacherous environment.
Yeah, and this was up 4%, but chances are anybody who bought this is down because the thing is, when you got like in this kind of uncertain market, you're going to buy with a little strength, it goes up, and then it comes down. So even though the stock was up 4% for the week, I bet new buyers are almost certainly down, just almost by definition, because anybody from this week, they had to buy it on the gap up. So that's the kind of things that also can happen. Even when the stock goes up, you can end up being a loser in this kind of week.
Yeah, and as we talked about on IBD Live this morning, in all market conditions, you should know your exit plan before you enter any trade, but especially in a market like this where things can move so quickly. We definitely want to be preserving capital. That's top of mind right now. And last but not least, let's take a look at a stock in the oil and gas area, and that is Exxon Mobil. Looks a lot like XLE. Did reverse lower a little bit on Friday, but a strong week for XOM, gaining almost 16%. So that weekly bar definitely stands out on the chart.
Yeah, and I picked this one as opposed to some other names, and there's plenty of good names, but I like this because it wasn't too far away from the 10-week line and the 50-day line. They also, and something that also helped Exxon beyond, I mean, obviously it was mostly the oil prices, but they also gave a Q3 update that was stronger than it suggested. It was going to be a pretty strong quarter. So, it sort of cleared a trend line on like a sort of a downward sloping trend line from there, or even from the very top, or just from 101. At least it got there temporarily. So there were some entries in there. So RS line at a high, growth strong, but the whole sector is strong. And as you said, it looks a lot like XLE. This is the biggest component in it. So it's not too much of a surprise. That's another way to go. But there is the issue. Has it run up a lot? Sure.
Right.
But
so
that's
maybe
always,
wait for some sort of pause or handle reversal at this stage.
that would be nice. It'd be great if it could form a little handle or some kind of little pause. But the market really hasn't been doing what investors want for the past year, I'd say.
We can always hope, we can always hope. All right, Ed. So now that we have that assessment of the overall market, what should investors be doing to prepare for the week ahead? I mean, going through those different industry groups, making sure we're staying on top of what's holding up and also taking note of what is moving down in the pack. And, it might be time to update those watch lists. I'm going to steal a line from you again, but it's you should probably mark your watch list in a pencil, not a pen.
Yeah, there's a lot of stocks that are going to be coming on and off over the last week or so. And, it's still possible we could have a follow-through day next week. I'm not, that seems
Yeah.
odd. The CPI report is on Thursday, so that's something to watch. So you still want to be ready to be, in case that goes, at least to be acknowledged that, still with caution. So look for stocks that are setting up close to buy points, but then also have a wider list and making sure you have a broad from a lot of different sectors of stock with strong relative strength, even if their charts are somewhat damaged.
Right.
And, it's still, if you took new positions, you might have needed to get out of them. Even in the energy or medical space, you could decide to take partial profits just because you want to lock that stuff in, given the market conditions. But just know your strategy, keep your overall exposure light,
Yeah.
and stay engaged because the market's obviously in flux
Hmm.
right now.
Yeah, I feel like that's the tricky thing. I mean, you and I interact with traders every day who are following IBD strategies, but within that, there are different takes. There are some investors who are, maybe a little bit more nimble and aggressive right now, taking some opportunities. Perhaps some are working, especially if they're in the energy area, or maybe on the short side, or maybe really short term trades. But I'm sure there's also a lot of traders out there who are trying things and getting dinged up, continuing to get dinged up out there, which is not fun. And I feel like the tricky thing is, I'm sure there, are some who are doing that who think, well, one of these days it's going to work, and I am going to be in early on that next big move higher in the market. But I feel like that can also be very draining if investors are continuing to try and get dinged up. And would it be better to be on the sidelines, or are the people on the sidelines then going to be too late to the party? What do we do? What's the right approach?
Well, this is why I think the follow-through day approach is a good one. That isn't a foolproof method. We've had some failed follow-through days for sure, but at least you don't try to get right in the first day or two. You wait a few days and then see some real power that at least gives you some sense that institutions are into it. Maybe there'll be a tradable rally and maybe it'll work and maybe it won't. So I think that alone, that's a way. That's sort of a nice balance because you don't get in too late. If the rally has real legs, if it's a follow through day and this rally goes on for 3 months, 6 months, or a year, the fact that you got in on day 6 instead of day 2, that's
Mm-hmm.
fine. But constantly trying to guess the new rally and getting in on
Right.
day 1, and that can work when we're doing these shallow pullbacks and everything bounces right back. But in a bear
Right.
market, just get hammered and hammered and hammered. So yeah, I think that's where the follow through days really, really come in. They're not a guarantee, but they provide a nice sort of middle ground there.
Mm-hmm. I totally agree, and I know you and I right now we're on the sidelines with our popcorn,
Yeah.
but watching how things unfold. And good luck to everyone out there, and hopefully our guidance here on the show and also IBD Live can help you weather this rocky market. All right, everyone, thanks so much for tuning in. Speaking of IBD Live, we hope you join us on Monday, investors.com/IBD Live, for all the details on that, where we will be joined by Arusha Pires. He's portfolio manager at O'Neill Global Advisors, for his monthly appearance on the show. That'll be great. And then coming up on Wednesday, we will be welcoming back Mark Minervini, two-time U.S. investing champion, to the show. So it'll be great to get his take on some of the signals that he's looking at in the market to see if we could be getting a turn. Thanks for tuning in, everyone. We hope you have a great weekend, and we'll see you back here next week.